The truth about making 30% returns, what Charlie Munger never told the crowd. Most investors fail not because the market beats them, but because they can't master their own minds. It's a strange thing, really. People spend years studying balance sheets, memorizing formulas, analyzing trends. They become experts in everything except the one variable that determines their success, themselves. Charlie Munger understood this better than anyone. When people would approach him, eager and hungry, asking how he managed to generate 30% annual returns, his answer wasn't what they wanted to hear. He didn't hand them a stock tip or a secret algorithm. He told them the truth: the hard part isn't making 30%. The hard part is not being stupid while you're trying. And if you find value in this kind of rational, no-nonsense wisdom, consider subscribing. We're building a community of mature investors who think clearly, act patiently, and refuse to follow the crowd. Most people think investing is about brilliance. They imagine some genius sitting in an office, predicting market movements with supernatural precision. But that's not how wealth gets built. Munger and Buffett never aimed for 30% returns every single year. They aimed for rational decisions every single year. Sometimes those decisions happen to produce 30%. Other times, those decisions simply saved them from ruin, which, as Munger would say, is even better than making money. Because in markets, avoiding disaster is more valuable than chasing miracles. Think about that for a moment. We live in a culture obsessed with action, with doing something, with constant motion. But wealth doesn't come from motion. It comes from stillness punctuated by moments of decisive action. The market is full of people chasing miracles, calling it innovation when it's really just speculation dressed up in expensive clothes. Back in the 1960s, while everyone else was predicting the next boom, Munger and Buffett were buying businesses they could actually understand: Coca-Cola, See's Candies, newspapers. Things with moats, not miracles. Things that would still be there in 10 years, 20 years, generating cash while everyone else's sure things had vanished into bankruptcy. What's the biggest financial mistake you've learned from so far? Comment below, because every investor's journey includes failures that taught them more than any success ever could. Here's what separates the wealthy from the perpetually hopeful: understanding that compounding doesn't forgive stupidity. You can make 30% one year, feel like a genius, and then lose 50% the next year because you got overconfident. The math is absolutely merciless. If you lose 50%, you need a 100% gain just to break even. Most investors never do that math. They prefer the story, the narrative, the excitement. Every decade brings a new one: the Nifty 50 in the 70s, the dot-coms in the 90s, the crypto revolution in the 2020s. Different names, same disease. Greed wrapped in optimism. And optimism in investing, Munger would tell you, is a form of blindness that makes you ignore the single most important variable: the price you pay. You can buy the greatest business in the world, but if you pay too much, it becomes a poor investment. This is something mature investors understand instinctively after years of watching their younger selves make expensive mistakes. When Munger and Buffett looked for opportunities, they didn't start with dreams or projections. They started with the balance sheet. Numbers don't lie, but they do whisper, and you have to be the kind of person who's patient enough to listen. Most people aren't. They'd rather listen to someone on television shouting about momentum, about the next big thing, about getting in before it's too late. The truth that nobody wants to hear is this: the market doesn't reward excitement. It rewards patience, logic, and a touch of boredom. That's the trio that quietly builds wealth generation after generation while the gamblers burn out, lose everything, and start over. Munger watched smart people ruin themselves repeatedly, and it was never because they lacked intelligence. They had high IQs but low emotional control. And in markets, emotion beats intelligence 9 times out of 10. That 10th time, that's just luck pretending to be skill. If you genuinely want a 30% return over the long term, you need to stop asking how to make more money and start asking how to lose less of it. Every great investor eventually learns this lesson, usually the hard way, through painful experience that cost them dearly. Munger and Buffett learned it too. Their biggest gains didn't come from chasing brilliance or trying to outsmart everyone else. They came from methodically avoiding stupidity, staying away from debt that could destroy them, refusing to buy fads that everyone else was piling into, never investing in something they didn't truly understand at a fundamental level. It's completely unglamorous. It won't get you applause at cocktail parties where everyone's bragging about their latest cryptocurrency bet or their tech stock that doubled in a month. But it works, year after year, decade after decade. And here's the funny part that Munger discovered after building one of history's great fortunes: once you truly understand this principle, you stop wanting 30% a year. You start wanting peace of mind instead. And that's precisely when money finally starts coming to you, because you no longer need it to prove anything to yourself or anyone else. The mistake most people make is trying to be brilliant investors. That's their first fundamental error. They think success in markets comes from outsmarting everyone else, as if investing were some kind of intellectual chess match where the cleverest person wins. But it's not a chess match at all. It's more like a survival game, and the prize goes to whoever makes the fewest catastrophically dumb moves over the longest period of time. You genuinely don't need to be brilliant to make money in markets. You just need to be consistently not stupid. And that's considerably harder than it sounds, because stupidity in markets comes dressed in the most appealing costumes: excitement, trends, innovation, the illusion of knowledge. It whispers to you that you're smarter this time, that you've learned from past mistakes, that this situation is genuinely different. And before you know it, you're buying tulips, or .coms with no revenue, or cryptocurrencies with dog faces. Munger watched this cycle repeat for nearly a century. Each generation genuinely believes it's immune to foolishness until reality proves otherwise. Back in 1999, everyone thought they were geniuses. You could buy practically any company ending in .com and double your money in a week. The problem, which seemed irrelevant at the time, was that those companies didn't have earnings. They didn't even have products. They had dreams, PowerPoint presentations, and enormous amounts of venture capital smoke. When it all crashed, as it inevitably had to, the so-called geniuses learned a painful truth: it's significantly easier to look smart in a bubble than to stay solvent after it pops. Before we continue, consider subscribing if this kind of clear-eyed, rational thinking resonates with you. We're cutting through the noise to help mature investors build lasting wealth. Avoiding stupidity means starting every investment decision by asking a question most people skip entirely: what could go wrong here? Most investors begin with the exciting question: how much can I make? But that's backwards. The right question is always: what's my downside if I'm completely wrong about this? You would be genuinely amazed at how much wealth has been preserved and compounded simply because the owner refused to be reckless, refused to use leverage, refused to bet everything on a single outcome. Munger and Buffett built Berkshire Hathaway on an extraordinarily simple premise that sounds like a cliché until you actually try to live by it: don't lose money. That's not some cute slogan for motivational posters. It's a commandment carved into their decision-making process. Because if you lose 50% of your capital, you need a 100% gain just to get back to where you started. That's basic mathematics that most people ignore until it ruins them completely, often when they're approaching retirement and don't have time to recover. Here's the profound irony: avoiding stupidity automatically puts you in the top 10% of all investors, because the other 90% are too busy chasing brilliance. They buy complexity because it feels sophisticated and makes them feel smart. They confuse activity with progress, filling their days with constant trading and monitoring. They think volatility equals opportunity when actually, as Buffett likes to say, volatility just reveals who's been swimming naked when the tide goes out. Munger spent 70 years watching investors, and he learned something that most people never grasp: the urge to do something, to take action, to be involved, is the single biggest destroyer of wealth. People simply cannot sit still. They cannot tolerate boredom. So they chase noise, trade far too often, and pay the market's most expensive tuition: experience bought at premium prices. When Munger and Buffett encountered stupidity in the market, they didn't criticize it or complain about it. They thanked it silently, because stupidity in markets is the fuel that powers opportunity for the rational. If everyone in markets were rational, bargains simply wouldn't exist. But people aren't rational, especially not with money, especially not when emotions are running high. Munger and Buffett made fortunes buying assets from the impatient, the emotional, the overconfident. These people sold genuinely good assets for fundamentally dumb reasons: fear during downturns, envy when others seem to be getting richer faster, or the psychological need to impress someone at a dinner party. The stock market, over sufficient time, operates as a machine that transfers money from the restless to the patient, from the hopeful to the disciplined, from those who think they're clever to those who manage to stay sane. You don't win by being extraordinary in some superhuman way. You win by being reasonable when others aren't. When people ask for the formula to achieve 30% returns, here it is in its elegant simplicity: avoid stupidity consistently and let everyone else chase genius enthusiastically. The mathematics will take care of the rest. Because while the crowd stays busy trying to predict next quarter's interest rates or the Federal Reserve's next move, you'll be sitting there calmly, owning quality assets purchased at fair prices, letting time, that ultimate silent partner, do the compounding work for you. You'll look boring to others. You'll sound unimpressive at parties. But 30 years later, when you're financially secure and they're still chasing the next hot tip, you'll have the last laugh. The quiet, satisfied laugh of someone who played the long game correctly. So yes, rule number 1 sounds almost insultingly simple: avoid stupidity. It is simple. But simple isn't remotely easy, especially in a world that's genuinely addicted to excitement, to action, to the dopamine hit of seeing your portfolio move. If you can master that one principle, if you can genuinely resist the constant urge to act smart and make complex moves, you're already halfway to achieving sustainable 30% returns over your investment lifetime. Which of Munger's principles do you find hardest to practice in your own investing? Let's discuss it in the comments, because we all struggle with different aspects of rational investing. The financial world absolutely worships diversification. Munger didn't. In theory, diversification sounds perfectly sensible, even prudent. In practice, however, it's what people do when they genuinely don't know what they're doing. If you know absolutely nothing about investing, then yes, owning 100 different stocks is considerably safer than owning just one. But if you truly understand a few businesses at a fundamental level, owning 100 becomes an unintended confession: you have no real idea which of these will actually work. Munger and Buffett never owned a zoo full of stocks. They owned what Munger called a few elephants, big, intelligent, predictable creatures that earn genuine money year after year without drama. They didn't need to own the entire jungle of available investments, just a few of the very best animals, and then the patience to let them grow undisturbed over decades. The idea of focus investing came naturally to Munger. It was logically obvious: why would you put your 10th best investment idea ahead of your first best idea? Yet that's exactly what most people do through excessive diversification. They spread themselves impossibly thin to feel safe, not realizing that excessive diversification is really just a form of insurance against their own ignorance. When you truly understand a business, its economics, its competitive advantages, its management, its future, you don't need 50 of them cluttering your portfolio. You need a careful handful that you'd be genuinely proud to own even if the stock market closed for 10 years and you couldn't check prices or trade. Because lasting wealth isn't built by owning everything available. It's built by owning the right few things for an unreasonably long time. Back in the 1960s, Berkshire bought See's Candies. It wasn't glamorous or exciting. It wasn't a technology stock promising to change the world. But it had something more valuable than promises: a genuine economic moat. It had loyal customers who came back year after year, pricing power that let them raise prices without losing affection, and the rare ability to increase margins during inflationary periods. Munger and Buffett didn't need a complex spreadsheet model to see its value. They could see it in the genuine smiles of customers who bought those chocolates every Christmas, every Valentine's Day, year after year. That's what real understanding looks like in investing. You know the product intimately. You understand the customer psychology. You grasp the fundamental economics. You can identify the protective moat. You can't get any of that understanding from staring at a stock chart or reading analyst reports. You get it from thinking deeply, reading extensively, talking to customers, and occasionally, yes, eating a lot of the candy yourself to understand its appeal. People mistakenly think understanding means memorizing financial numbers and ratios. It doesn't mean that at all. Understanding means knowing what genuinely drives a business at its core and whether the driver will remain sustainable through different economic environments. Ask yourself these simple but profound questions. Can this business survive extended bad times? Can it raise prices without losing customers? Does it depend fundamentally on borrowed money or temporary fashion trends? And perhaps most importantly for mature investors, can I sleep soundly at night owning a concentrated position in this? If you can't answer those questions with confidence, you don't truly understand the business. And if you don't understand it, you absolutely shouldn't own it, no matter how exciting it seems or how many talking heads on television recommend it. That's not being overly cautious or timid. That's being genuinely sane in a world that often isn't. During the 1990s, Munger and Buffett watched everyone around them chase technology companies they clearly didn't understand. These investors used impressive words like scalability and network effects, but couldn't explain in simple terms how the business actually made a single dollar of sustainable profit. That's not investing. That's vocabulary masquerading as analysis. True understanding keeps you psychologically grounded when the world goes mad. When the crowd reaches peak euphoria and prices disconnect from reality, you'll know exactly why you're not joining them in the frenzy. And when panic inevitably hits and prices crash, you'll know precisely why you're not selling in fear like everyone else. It's profoundly ironic, the less you diversify, the more you're forced to think carefully. And thinking, for most people, represents too much actual work. So they diversify excessively instead, hiding behind the illusion of safety. But focus investing isn't reckless gambling when done properly. It's actually the opposite of reckless. It forces genuine discipline upon you. It makes you personally accountable for what you own. You cannot hide behind portfolio averages when you only own 5 carefully chosen businesses. You either understand them deeply or you don't. And the results, positive or negative, will show clearly. That's why Munger said for decades that the idea of excessive diversification is genuine madness, taught by people who'd rather look sophisticated than be effective in building real wealth. If you're managing other people's money professionally, you diversify extensively to protect your career and avoid getting fired. If you're managing your own retirement money, you concentrate carefully to build your actual wealth. Of course, focus naturally increases volatility if you measure risk purely by short-term price movements. But Munger and Buffett never measured risk that way. They measured risk by the probability of permanent capital loss. And when you understand your businesses deeply and fundamentally, that probability of permanent loss stays genuinely low through market cycles. So the second rule for achieving 30% returns over time is elegantly simple: find a few things you truly understand at a deep level. Ignore everything else, no matter how exciting it appears. Because the market consistently rewards clarity of thought over time, not the temporary illusion of sophistication. And if your portfolio looks boring to others, that's probably a genuinely good sign. It means you finally understand what you're actually doing with your life savings. The stock market absolutely loves action. Traders, analysts, television pundits, they all make their comfortable living from constant movement, from volatility, from exciting stories about what's happening right now. But lasting wealth doesn't come from movement or excitement. It comes from patient waiting punctuated by occasional decisive action. Patience in markets represents the single rarest form of intelligence. And yet, it's consistently the quality that pays the most over lifetime investing careers. Munger and Buffett learned early in their partnership that you don't need to swing at every pitch that comes across the plate. In fact, the real secret is not swinging at most of them. You simply wait, sometimes for months or years, for what Munger called the fat pitch, the one that's right in your circle of competence, so clear and obvious that it feels almost unfair to profit from it. That's genuinely how they made their biggest returns over decades. Not through constant trading or complex strategies, but through selective aggression after long periods of patience. People forget that investing isn't like baseball with its strict rules. There are no called strikes in markets. You can stand there all day, all month, all year, and nobody will yell, "You're out," and send you to the dugout. But human nature genuinely hates inactivity. It craves excitement, validation, noise, the feeling that something is happening. So people swing at garbage pitches just to feel alive and involved. They tell themselves they're seizing opportunity when really they're just swinging themselves steadily into poverty through fees, taxes, and bad decisions. Let me give you a concrete example that illustrates this principle. In the early days of their partnership, Munger and Buffett would sometimes sit on enormous mountains of cash for years at a time. Other investors thought they were crazy or wasting opportunity. But they weren't being idle at all. They were being strategically patient. They were waiting for market prices to come their way. And when prices finally did come down to genuinely attractive levels during market panics, they moved with total conviction, buying heavily while everyone else was paralyzed by fear. That's the sustainable rhythm of genuinely intelligent investing: wait, wait, wait some more, and then act decisively when your moment arrives. The market constantly tests your discipline through temptation. It tempts you daily with half-good ideas and shiny distractions that seem urgent. But good ideas are actually common in markets. Great ideas are genuinely rare. And the rare ones that can change your financial life require you to do something most people psychologically cannot do: absolutely nothing for extended periods. The key to achieving 30% returns over a lifetime isn't trading more frequently or finding more ideas. It's trading significantly less but considerably better. One truly great investment decision in a decade can easily beat 1,000 mediocre ones. But to catch that great opportunity when it arrives, you have to stand perfectly still while everyone else runs frantically in circles, exhausting themselves and their capital. Patience also provides another crucial benefit that people underestimate: it naturally filters out emotional decisions. When you force yourself to wait patiently for genuine opportunities, you automatically avoid acting purely out of greed or fear. And those two primitive emotions are directly responsible for roughly 90% of serious investment mistakes that people make throughout their lifetimes. People mistakenly think opportunity comes from genius-level analysis. It doesn't. It comes from discipline and from being psychologically and financially ready when the world periodically loses its collective mind. In 1973 and 1974, the stock market fell completely apart. Great businesses with strong fundamentals were selling for absurdly low prices that made no rational sense. Everyone was panicking about inflation, about oil, about economic collapse. Munger and Buffett were buying aggressively, not because they were fearless or enjoyed taking risks, but because they were prepared. They had the patience, the cash reserves, and the mental clarity to recognize a genuine fat pitch when it finally came across the plate. You cannot predict precisely when the next fat pitch will appear in your investing lifetime. But you can absolutely guarantee one thing: it won't wait around patiently for people who are unprepared, who are fully invested at any price, who have no cash reserves, who haven't done the intellectual work. So while the crowd chases every flicker of excitement and every trending stock, you quietly build your cash position, steadily build your knowledge base, and carefully build your emotional temperament. Then, when that perfect pitch finally comes, and it will come, maybe 2 or 3 times per decade if you're paying attention, you swing extremely hard with concentrated conviction. The market doesn't reward the busy people. It rewards the disciplined ones. And discipline at its fundamental core is simply the ability to wait without frustration or anxiety. Most investors genuinely cannot handle that extended silence. They mistake healthy inactivity for failure or missed opportunity. But wealth doesn't grow through constant motion. It grows through patient compounding. And compounding only works its mathematical magic if you give it sufficient uninterrupted time. If Munger had to sum up this principle in one memorable line, it would be this: wealth over a lifetime is the direct reward for waiting patiently for the world to make a serious mistake. And when it inevitably does, you'd better be completely ready. The fat pitch doesn't come every week or even every year. But when it does appear, it can genuinely make your entire investing career. That's ultimately how you achieve 30% returns over sufficient time. Not by swinging harder at everything, but by waiting considerably longer for the right opportunities. Because as every foolish investor eventually learns through expensive experience, it's not the missed opportunities that financially ruin you. It's the bad swings you didn't actually need to take. You don't get rich over a lifetime by being timid or paralyzed. You get rich by being rationally bold when the odds are heavily and obviously in your favor. When the mathematics and logic clearly point in one direction, you swing big with real conviction. That's genuinely how lasting fortunes get made, not from constant motion and activity, but from concentrated conviction applied at exactly the right moments. This rule genuinely terrifies most people. They like the abstract idea of big returns, but they don't want the personal responsibility that comes with concentrated bets. They want the upside of courage without accepting the downside of consequence. But that's simply not how reality works in markets or in life. When you find something that's truly obvious, not emotionally exciting or speculatively attractive, but mathematically certain enough, you have to act with meaningful size. If you don't commit sufficient capital, you're essentially wasting the rare opportunity. Munger said it clearly for years: opportunities come infrequently in investing. When it rains gold, you put out the bucket, not the thimble. The fundamental problem is that most people cannot tell the difference between genuine rain and temporary illusion. They see glitter and automatically assume it's gold. They buy noise instead of value. And then they wonder why they end up broke or struggling financially in their later years. Munger and Buffett made their biggest money when they made their biggest, smartest bets. Not random bets driven by emotion. Not speculative bets driven by hope. But carefully calculated bets driven by deep understanding. Take See's Candies again as a clear example. They paid $25 million for it back in 1972. At that time, that seemed like a substantial amount of money. But they knew intimately the brand's genuine power, the pricing ability, and the durability of customer demand. They were betting not on sugar or chocolate, but on deep customer psychology, the psychology of customers who loved it too much to ever switch to competitors. That single thoughtful, concentrated decision went on to produce over $2 billion in pre-tax earnings over the following decades. One intelligent, concentrated decision carefully made. That's the real power of betting big only when you genuinely know what you're doing. People worry that concentration increases risk in portfolios. That's only true if you don't understand your bets at a fundamental level. If you do understand them deeply, concentration actually reduces risk because you've systematically eliminated ignorance from the equation. The real risk in investing isn't having all your eggs in one carefully watched basket. It's having them scattered across 100 baskets you've never properly inspected or understood. In poker, the best professional players fold roughly 90% of their hands. But when they know the mathematical odds are genuinely in their favor, they push all their chips to the center. That's how professionals play any probabilistic game, patiently, then decisively. Investing is no different from poker in this respect. Munger and Buffett don't buy a small position in a great opportunity just to feel emotionally safe. Real safety comes from deep understanding, not from hesitation. When they're genuinely sure about an opportunity, they bet big enough that it actually matters to their overall results. Of course, you'll occasionally be wrong even with careful analysis. Everyone is sometimes. That's precisely why they never used leverage. Leverage transforms good judgment into Russian roulette. Even a genius with a gun pointed at his head is still a fool. If you're going to bet big on concentrated positions, you must also build your personal fortress of safety: no debt, no desperation, no dependence on luck or favorable timing. That's what allows you to stay psychologically rational when others panic and sell. Most investors are never bold enough because they're always scared. And they're always scared because they never properly prepared. They don't study deeply. They don't save cash reserves. They don't wait for the right pitch. So when the rare perfect moment arrives, they either can't act or, worse, they act recklessly without understanding. The courage to bet big doesn't come from emotional bravado. It comes from years of preparation, from reading extensively, from thinking carefully, and from saying no repeatedly to everything that's merely average or good. In the 1970s, when everyone was running away from stocks due to inflation, pessimism, and fear, the usual cocktail during bear markets, Munger and Buffett were buying selectively. Not buying everything available, just the genuinely great businesses selling at stupid prices. And when those businesses recovered to rational valuations, they looked like geniuses. But they weren't geniuses. They were simply disciplined opportunists who did their homework. There's a fine but crucial line between boldness and stupidity. Boldness is when the odds are clearly on your side based on facts. Stupidity is when you merely think they are based on hope. The market punishes the latter with brutal efficiency. So when the odds are truly right, bet big, but only then. Don't confuse motion with opportunity. Don't confuse noise with knowledge. Because a few great bets in a lifetime beat 1,000 mediocre ones in a career. And remember this, the big wins are obvious only in hindsight to those who missed them. To those who took them at the time, they looked like rational courage based on careful analysis. That's rule number 4, be boldly concentrated when logic and mathematics demand it. Not before, not after. Because when it's raining gold, you cannot fill a bucket later. The storm moves on, and all that's left for the timid is regret. Tell me in the comments, what principle from this lesson will you apply starting today in your own investing approach? I read every comment. Cash in a portfolio is like oxygen in the air. You don't notice it when you have plenty. But the moment it's gone, you're dead financially. That's why Munger always said that only fools stay fully invested all the time. Smart investors always keep meaningful cash on hand, not because they love holding it or because they're bearish, but because they love opportunity when it arrives unexpectedly. The market has a predictable rhythm over decades: panic, euphoria, panic again. And every single time the crowd loses its collective mind, cash becomes a genuine weapon. You cannot buy bargains without available cash. You cannot think clearly without cash reserves. And you cannot survive chaos without cash to weather the storm. In 1973, when the market was collapsing and fear filled every newspaper headline, Munger and Buffett weren't scared or panicking. They were calmly shopping for bargains. Not because they had supernatural courage, but because they had substantial cash reserves ready. Cash gives you crucial psychological armor. When everyone else is panicking and forced to sell, you can sit there calmly, waiting patiently to pick up genuine treasures at prices that make absolutely no rational sense. It's remarkable when you watch it happen repeatedly over decades. The same people who mock cash holdings during bull markets are inevitably the first ones to desperately beg for liquidity during crashes. They call it lazy money when markets are rising. Munger called it strategic patience. Holding cash doesn't mean you're bearish on markets or pessimistic about the future. It means you're sober and rational. It means you refuse to buy stupidity just because everyone else is drunk on optimism. Most investors genuinely hate seeing idle cash on their balance sheet. They treat every dollar like it's actively on fire and must be immediately deployed somewhere. But not every job is worth doing, and not every investment is worth owning at current prices. Cash represents the discipline to say, "not yet," when prices are unreasonable. It's the strength to wait patiently for your pitch. And it's the ammunition to strike hard when opportunity finally knocks loudly. Munger and Buffett lived through more genuine market panics than most people can count: 1973–74, Black Monday in 1987, the financial crisis of 2008. Every single time it played out the same way. Those with cash reserves got richer. Those without begged for mercy or were forced to sell at the worst possible time. And every time, once the dust settled and markets recovered, people forgot the lesson again. They got greedy, fully invested, and proudly, all in, until the next inevitable storm hit. Cash isn't primarily an investment strategy. It's a survival strategy. It's the thing that keeps you psychologically sane while everyone else loses their minds. People frequently ask, "Charlie, how much cash should I hold?" His answer was beautifully simple: enough so that you never have to sell your best assets at the worst possible time. That's the entire principle. Because selling quality holdings just to meet liquidity needs is one of the dumbest ways to die financially in markets. You spend years carefully building positions in great businesses, then throw them away in panic because you didn't plan adequately for bad weather. In Munger's world, cash is like insurance. You pay a small cost, the opportunity cost of idle money, to avoid the enormous cost of forced stupidity during crises. It's genuinely funny when you think about it. In the short run, cash feels like a drag on returns. But in the long run, it represents freedom. Freedom to buy aggressively when everyone else is paralyzed. Freedom to sleep soundly at night. Freedom to completely ignore the noise. And that freedom, compounded over decades, is just as valuable as capital itself. You cannot think independently when you're desperate. And you cannot be rational when you're financially cornered. Cash prevents both situations. So yes, cash reserves might look lazy on a spreadsheet during bull markets. But it's the smartest form of laziness you'll ever practice. Rule number 5 is elegantly simple: always maintain enough cash to take advantage of other people's stupidity and to survive your own mistakes. Because markets always eventually come back. Opportunities always return. But only if you're still alive financially to seize them. That's what cash buys. Not luxury, not pride. Just survival. And survival plus compounding over decades is absolutely everything. You can have the best intellect in the world, the sharpest analytical skills, the perfect timing, and still lose everything if you cannot control your emotions in markets. Emotion is the real enemy, not inflation, not taxes, not competition. Just emotion. Munger watched people with genuinely high IQs self-destruct repeatedly because they couldn't stay calm when everyone else was losing their heads. They had all the intellectual capacity and none of the emotional temperament. And temperament beats raw intelligence every single time in investing. Munger and Buffett never thought of themselves as geniuses. They just stayed consistently rational when others weren't. That psychological advantage alone was enough to outperform 99% of investors over their lifetimes. It's genuinely astonishing how rare emotional control is in this business. Most people get rich slowly through patient compound growth, then spend the rest of their lives trying desperately to get richer quickly. They cannot sit still. They cannot tolerate being bored. So they gamble compulsively under the respectable name of active investing. Greed whispers constantly that this time will be different, that you're smarter now. Fear screams that it's all over, that you need to sell everything immediately. Both voices are lying. And both will systematically empty your retirement accounts if you listen long enough. When prices go up, people feel smart and validated. When prices go down, they feel stupid and panicked. But prices don't actually care how you feel. They just move based on supply and demand. Your only job is not to feel good. It's to think straight regardless of emotions. Munger always said that envy is the absolute dumbest sin because it's the only one that doesn't even make you feel good temporarily. And yet envy drives roughly half of Wall Street's activity. Everyone wants to outdo the next person. They measure success not by personal independence and peace of mind, but by comparison to others. That's pure emotional poison. The only scoreboard that genuinely matters is your own sanity and financial security. Markets are deliberately designed to exploit human psychological weakness. They systematically punish impatience, amplify fear, and reward the rare few who somehow stay calm through chaos. In 2008, people were literally begging for any liquidity. They sold blue-chip businesses for pennies on the dollar because their emotions had completely hijacked their reasoning ability. That's what real panic does. It replaces careful logic with pure adrenaline. The people who made genuine fortunes during that crisis were the ones who stayed cool while others melted down. They didn't need to be brave or heroic. They just needed to be rational. And rationality at its fundamental core is simply emotional discipline in action. The stock market over time operates as a giant psychological test disguised as a financial one. Every tick, every headline, every talking head is asking you the same essential question: can you stay sane? If you can, you'll do fine long term. If you can't, you'll become part of the expensive lesson for someone else. The best investors train themselves to be slightly emotionally detached, not heartless or uncaring, just calm and objective. They don't celebrate wins enthusiastically or mourn losses dramatically. They simply observe, learn, and move steadily forward. No drama. You cannot compound wealth effectively if you're constantly reacting emotionally. Compounding requires psychological stillness, the ability to let time do its work while you keep your emotions in check. People always ask, "Charlie, how do I stay calm during a market crash?" His answer was beautifully simple: don't do anything beforehand that would make you panic during the crash. If you're using leverage, you'll panic. If you bought what you don't understand, you'll panic. If you followed the crowd, you'll panic. But if you stayed rational, kept cash, and owned solid businesses, you'll sleep through the storm. Emotional mastery isn't about never feeling fear or greed. It's about not acting on those feelings. It's about letting logic override primitive instinct, a habit you build long before any crisis hits through practice and discipline. Remember this fundamental truth: the market is like a mirror. It reflects your temperament more accurately than your intelligence. And if you don't like what you see in that reflection, the problem isn't the mirror. So rule number 6 is essential: master your emotions before they master you. Because markets don't actually destroy wealth directly. People destroy their own wealth, one emotional decision at a time. The world doesn't stop changing just because you've made some money or reached a certain level of success. And yet, that's exactly what most investors do as they age. They freeze intellectually. They find one method that worked once and then spend the rest of their lives defending it like religious doctrine. That's how intelligence dies, not from lack of knowledge, but from arrogance and inflexibility. If you want to achieve 30% returns over your lifetime, or even just stay competent in any game that matters, you must become what Munger called a learning machine. Relentlessly curious, endlessly skeptical, always improving your mental models. Munger spent his entire life collecting ideas from physics, biology, psychology, history, not just finance and economics. Because reality doesn't care about your academic department or specialization. The world runs on interconnected systems. If you understand only one of them, you'll eventually step on a landmine you never saw coming. Most people stop learning seriously after formal school ends. That's a genuine tragedy for their potential. Formal education ends in your 20s. But the real education, the kind that actually builds wisdom and wealth, is what you give yourself voluntarily afterward. The greatest advantage you can develop is what Munger called a latticework of mental models. It's like a comprehensive toolbox for thinking. When you face a problem or opportunity, you reach for the right tool, not just the only one you happen to know. If your only tool is a hammer, every problem looks like a nail. And that's why most investors keep hammering themselves into bankruptcy or mediocrity. Munger and Buffett read constantly: books, annual reports, biographies, science papers, even old newspapers. They weren't reading to trade tomorrow or to get a hot tip. They were reading to think better forever. When you expose your mind to multiple disciplines, you start to see patterns that others miss. You recognize stupidity faster. You avoid repeating old mistakes disguised as new innovations. That's how you build durable wisdom that lasts through market cycles, layer by layer, thought by thought, mistake by mistake. The market rewards those who can adapt their thinking, not those who predict the future, not those who memorize formulas, but those who can genuinely update their minds when reality changes around them. Munger met countless investors over the decades who clung to old beliefs like sacred scripture. They couldn't admit when they were wrong. They couldn't change their minds even when the evidence clearly demanded it. And so the market changed their minds for them, painfully, through losses. Munger and Buffett changed their thinking plenty over the decades. They once hated owning technology stocks on principle. Then Apple came along, a business so fundamentally strong, so sticky with customers, and so beautifully managed that ignoring it would have been irrational. So they learned, they adapted, and they acted decisively. That wasn't betrayal of principle. That was the very essence of it. If you can't update your thinking when circumstances change, you're not an investor. You're a fossil waiting to be buried. Curiosity isn't optional in this game. It's oxygen. Because the moment you stop learning actively, you start dying, financially, mentally, and often literally. And don't confuse information with actual knowledge. The internet is overflowing with information but starving for genuine knowledge. Everyone's constantly scrolling, but almost no one's actually thinking deeply. Real thinking is hard work. It means sitting quietly with uncertainty. It means changing your mind when the evidence demands it. And it means accepting that wisdom often looks boring because it's built slowly, without drama or excitement. Munger always admired people who stayed lifelong students. They didn't act like they'd arrived at some destination. They acted like they're still climbing, still learning. And that intellectual humility compounds just like capital over decades. That's why he said the game of life is fundamentally the game of continuous learning. If you're not learning, you're not playing. You're just existing until the competition buries you. Rule number 7 separates the genuinely wise from the merely wealthy: keep learning, keep thinking, keep questioning your assumptions. Because 30% returns don't come from memorizing formulas or following rules mechanically. They come from constantly improving the quality of the mind that uses them. And here's the beautiful irony: the more you learn, the less you'll feel compelled to act. Because understanding brings natural calm, and calm over time makes you rich. If you're finding value in this deep exploration of Munger's wisdom, please subscribe. We're building something special here, a community of rational, patient investors who refuse to follow the crowd. Compounding looks simple on paper. Everybody thinks they understand it intellectually. But almost nobody actually lives by it consistently. They love the mathematics, but they hate the waiting. You can show people the most beautiful chart in the world, how $1 grows into a substantial fortune over decades, and they'll nod, smile politely, and then immediately ask, okay, but how do I double my money next year? That's precisely why compounding works for so few people. It demands discipline over brilliance, patience over excitement, and time over ego. The truth is that compounding doesn't require genius-level intelligence. It requires the psychological ability to keep your head straight while the rest of the world loses theirs repeatedly. Munger and Buffett didn't get rich from one huge bet or one brilliant insight. They got rich by letting small, intelligent decisions sit undisturbed long enough to turn into something extraordinary. Compounding is like growing a tree. You can't dig it up every month to check the roots or measure progress. You plant it carefully, water it consistently, and leave it alone. But that's far too boring for most people. They'd rather chase action because they confuse motion with progress. They end up exhausting their capital and their sanity. In Munger's experience over nearly a century, the biggest enemy of compounding isn't inflation or taxes. It's human restlessness, the inability to let time work its magic. Every great fortune you admire is fundamentally just compounded discipline wearing different clothes. You don't need to reinvent the wheel or discover some secret. You just need to stop kicking it every few weeks because you're bored or anxious. Here's the profound irony: compounding doesn't even look impressive at first. It's like watching paint dry. Nothing happens, nothing happens, nothing happens. And then suddenly everything happens. But by then, 90% of people have already quit. They couldn't stand the slow years. They wanted excitement. They traded away the magic of compounding for the illusion of control. Munger learned something fundamental from a lifetime of investing: it's not hard to make money initially. What's genuinely hard is keeping it quietly growing for 30 or 40 years without interruption. Wealth is ultimately a test of temperament, not intelligence. And compounding is the ultimate report card. That's why they avoided leverage religiously. That's why they held cash reserves. That's why they bought quality and sat still. Because compounding only works its magic if you survive long enough to enjoy it. People mock patience until they desperately need it. They call it boring. Well, boring is the secret ingredient of extraordinary wealth. A steady mind, a long timeline, a refusal to interrupt what's working. That's it. That's the whole secret. Compounding doesn't just apply to money. It applies to character, to wisdom, to reputation. Do small things right repeatedly, and over decades, the world will call you lucky. But you'll know better. Munger and Buffett never aimed to be brilliant every year. They aimed to avoid stupidity every year. That's what compounds over time, not cleverness, but consistency. Everyone wants the exponential curve, the exciting upward trajectory. Few want the flat line that comes before it. But if you can endure the flat line, those quiet, uneventful years when nothing seems to move, that's precisely where the magic happens. Because compounding hides its rewards until the very end. Rule number 8, or perhaps the real rule behind all the others, is this: never interrupt compounding unnecessarily. Don't panic when prices fall temporarily. Don't celebrate excessively when they rise. Don't chase. Don't tinker constantly. Don't overthink every decision. Just keep doing the rational thing long enough for the irrational crowd to destroy itself. And when they do, you'll find yourself looking rich. Not because you were smarter than everyone else, but because you were calmer. Compounding doesn't make you rich fast. It makes you rich forever. And there's a profound difference between those two outcomes, one that mature investors understand deeply. Everyone wants a 30% return. But almost nobody deserves it, because that kind of performance isn't earned in a single year through brilliance. It's earned over decades through patience, restraint, and relentless rationality. The irony is that once you develop the discipline to achieve 30% over time, you stop needing it psychologically. You realize that the pursuit of high returns was never really about the money. It was about developing the right mindset. Most people think investing is about predicting the future with precision. It's not. It's about surviving the present without doing something stupid. Munger saw fortunes made by quiet people who avoided noise, avoided envy, and simply stayed in the game long enough. And he saw fortunes lost by people who couldn't stop touching their portfolios constantly, as if success required perpetual motion. It doesn't. It requires endurance. A 30% return isn't some magic number to worship. It's a reflection of habits, 7 habits to be precise. First, avoid stupidity consistently. Don't chase brilliance. Sidestep disasters. Second, focus on what you understand deeply. Ignorance is far more expensive than concentration. Third, wait patiently for the fat pitch. Opportunities are rare. Act decisively when they appear. Fourth, bet big when the odds are clearly right. You only need a few great decisions in a lifetime. Fifth, keep meaningful cash reserves. Because panic is the enemy of the unprepared. Sixth, master your emotions completely. The market can't hurt you unless you cooperate. Seventh, keep learning continuously. The world changes. Your thinking must evolve with it. That's it. No secret formula, no mystical insight, just a few simple principles repeated without interruption. But here's the catch: they only work if you have the temperament to actually follow them. And temperament, unlike intelligence, can't be taught in a classroom. It's built slowly through experience and pain. Munger lived long enough to see the same movie play out over and over. The crowd rushes in during euphoria and rushes out during despair. They repeat the same mistakes every decade because they never learn the one lesson that matters: how to think independently. If you want 30% returns over your lifetime, learn to be comfortable with boredom, indifferent to noise, and allergic to stupidity. Because markets reward the few who can remain calm while everyone else chases illusions. People ask for advice on how to get rich. Munger told them the first step is not to be poor. What he meant by that is simple: don't make the dumb mistakes that destroy compounding. And if you can avoid those mistakes long enough, wealth genuinely takes care of itself. The goal isn't to beat the market every single year. The goal is to never do anything that takes you permanently out of the game. At the end of the day, the 30% return isn't about numbers on a screen. It's about character. The kind of mind that stays rational when the world goes insane. That's what Munger and Buffett built their lives on. Not brilliance, not luck, just ordinary intelligence applied consistently for an unreasonably long time. And if you take only one lesson from all this, let it be this: you don't have to be smarter than everyone else. You just have to be more rational than the rest. That's how you make 30% a year over time. That's how you stay rich forever. And that's how you live a life where your money compounds steadily, but your sanity does too. Before you go, consider subscribing if this resonated with you. We're cutting through the noise to bring you the kind of rational, mature investing wisdom that actually builds lasting wealth. And tell me in the comments, what principle from Charlie Munger's philosophy will you apply starting today? I read every comment, and I'm genuinely curious about your journey. Remember, this isn't financial advice. This is educational content designed to help you think more clearly about wealth, investing, and rational decision-making. Charlie Munger spent nearly a century learning these lessons. We have the privilege of learning from his wisdom without paying the full price he paid. That's a gift worth taking seriously.